Let's bring in Richard Clarida. He's got to be more exciting than the data check that I just did. I was sort of a quiet here after the shutdown. Your thoughts as one of our leading economists on what you politically observed the last 5 or 6 days in Washington.
Well, it was really remarkable. I guess sometimes 11th hour deals do get struck at the 11th hour. One has to imagine there was a bit of stage management behind the scenes there. But I think it was significant in a couple of ways. There was a shutdown averted, a pretty material reduction in government outlays, certainly compared to what a lot of people thought would be possible several months ago. And we heard over the weekend with some of the president's key people that he will be rolling out a second version of his budget in a couple of days.
Version 2.
Yeah.
We need a crisis. No crisis left unsaid, or whatever the phrase is. Where's the crisis going to come that will lead us to a fiscal and indeed a monetary solution? Is it the 10-year yield you have to watch?
Well, I think so. I think there are a couple of things. Certainly the Fed's watching break-even inflation right now.
If that breaks out.
If that breaks out. I think you look at developments in the periphery of Europe, where obviously that's an extreme case where countries are having difficulty rolling over the debt. The U.S. is not there yet, but certainly the long-term numbers do look scary.
We've been there before. Richard Clarida, he was in the Adams administration. Let's bring up this chart here, 2 centuries of national debt. It's a dreaded first chart. We've shown this. We just rolled this out. Folks, we're putting together 20 or 30 heritage charts. This goes back to 1790, the Revolution debt, the Civil War debt buildup, Fort Sumter this week, the anniversary. There's that World War II buildup and that pay down. This is remarkably different. This from Elmendorf's CBO.
Yeah.
What a remarkable mess we're in.
Well, certainly, I think, certainly right now, having spent time in Washington, we always would talk about the out years and the long-term projections for things like entitlement. And the out years are basically upon us right now. Depending upon your estimates, the entitlement programs begin to go into significant deficits in 5 or 6, 7 years. And so that's within the window. And it looks like the president and the Congress are going to begin to have that conversation. Now, who knows if it leads to a material package, but they're at least going to have that conversation.
Let's bring up chart 5 here. Yeah. Bring up chart 5. This is the 2-year yield. I mean, I'm sorry, it's moving. Let's start. Look at the thickness here at the zero bound over in the lower right corner. Right. How wide that thickness is versus other cyclical lows in the 2-year, given the great moderation. Yeah. Nice camera work, Victor. I mean that big thickness there. At what yield point do we begin to say the 2-year yield? Speaking of inflation, is it a 1%?
Well, interestingly enough, Tom, we may begin to see the inflation pressure further out the yield curve. The very front end is anchored by what the Fed's going to do over the next 6 or 9 months. And if the Fed's on hold, as I think they will be till 2012, that'll stay down. So you'll see the inflation pressure, the 5 and 10-year points. And as I said, you'll see it in the break-even inflation measures.
Let's look at, bring up core, bring up elegant chart 1, folks. We've shown this chart again, too. You're one of the best qualified to talk about this. It's an elegant chart. Core EU, core US, they end at the same point. That's not played with. That's a real overlay of those 2 series.
Got it, yeah.
What a remarkable different policy, as Caroline Baum writes about today. It's just remarkable, the 2 different bank policies given. He's dazzled. Rex, you're right. Richard Clarida's dazzled by those gorgeous charts. It's 2 separate policies.
Yeah, no, what we've seen in Europe is really noteworthy because you have a relatively young institution. The ECB's only been around for a dozen years. Really on the last several months of the leadership of President Trichet, who, by the way, I think has done just a remarkable, outstanding job, one for the history books. And he made really a bold decision, which is to start hiking interest rates, even though core inflation's well behaved, and even though there are challenges in the periphery. Many people, including myself, that decision would be delayed in 2011. And he made that decision. Why? Because headline inflation is running above 2%, and the ECB, unlike the Fed, does not like to distinguish between headline and core. So
Which do you do? What does Pimco do? I'm going to make some news here.
Yeah, okay. Yeah. Well, no, I think I try to decide what the Fed is up to, and the Fed, certainly Mr. Bernanke and Dudley and Yellen and many of the folks on the FOMC have indicated that historically it's core that provides the best forecast of inflation, and that's certainly the one that I focus on. But we all recognize that in periods when they diverge, the Fed does have a challenging communication, and we may be in one of those periods now.
The Gaussian is the bell curve, like our high school height. And there's other guesses of where we're going. When you make a statement like you did, bring up this quote again, folks. This is from a year and a half ago, I'm guessing.
Yeah.
We are in a new normal world in which the distribution of outcomes is flatter and the tails are fatter. This is the professor fighting back against the certitude of financial economics, isn't it?
Well, yes, and I think we do need to do that. I mean, the assumptions that are used in financial models are very powerful, many of which assume that asset prices, exchange rates behave according to normal distributions. But the trouble is, in the real world, they don't. And so any models based upon those approximations break apart, and they certainly broke apart during the financial crisis. And in my view, going forward, you need to move away from those assumptions and accept that you've got fat tails.
Which is the dynamic in those tails that you're most concerned about?
Well, it depends on what you're looking at. For example, at inflation, there's a very plausible story that the risk to inflation is on the upside with QE. There's another plausible story that says with a big output gap, and the Fed was concerned in October that the risk is to deflation. And so there's just more uncertainty about extreme outcomes than we saw in the Great Moderation.
Right. Too much information, if you would, Rex. I want to bring this up. Now, this is a great chart. I'm stealing this again from, I believe it's the Congressional Budget Office. There it is. Yes. Long-run growth in the labor force. A nation is based on the growth of its labor economy. It's been ugly. There's a projection. Nice projected actual bar. I like that. But the answer is there's not much labor force growth. What nominal GDP, what oomph do you need to close that output gap? Is it 5% plus?
Well, yeah, definitely 5%. Definitely 5% plus. We have a big output gap. There's a lot of uncertainty, Tom, about the output gap. That's one of the other fat tails. The labor market is a puzzle to the Fed and others because of labor force participation. A lot of the decline in the unemployment rates happen because people have stopped looking for jobs. If they come back into the labor force, that's good for long-run supply, but it means a larger output gap.
Can a government change nominal GDP? Can there be government policy? You got real GDP, you got the inflation on top of it. Is policy just too squishy of an instrument where it really doesn't adjust?
I think governments can change nominal GDP, but historically they do so by generating inflation. You can't print your way to prosperity, but you can certainly print your way to nominal GDP if it shows up in inflation.
Let's do a chart 6 if we would here, folks. We're jumping around with Richard Clarida because there's so much to talk about. Richard, you're supposed to tell me my bow tie's out of whack. Come on. In search of the limit. There it is. There. See, it's a little... Who dressed me today?
It's a skewed distribution there.
Yeah, it was. In search of the limit. Okay, we've shown this chart ages. This is total debt to GDP, pushing out to 14 trillion. Blanchard is just speaking within the hour at the IMF. He chastises the United States within the World Economic Outlook about our fiscal policy. Should he be doing that? Is it that out of whack?
Well, I think it's, as of right now and as of the time that the IMF put that report, there's really not a long-term fiscal policy in the U.S. We may get to that in the next year or two. But I think it's fair to say that the president's budget rolled out in February was a placeholder, which is why perhaps the White House now is taking a second shot at rolling that out. We've seen the Ryan proposal, a very ambitious plan, controversial plan that would take on entitlements. And down the road, that's what the solution is going to have to look like.
Is the solution going to be solved at our central bank, or can these other institutions pick up their responsibilities as well?
The central, not only will it not be solved at the central bank can't solve it. This is ultimately a fiscal problem. It will require a fiscal political resolution. In fact, I think the central bank, the Fed, wants to get out of the business of doing fiscal policy.
Well, that's where I was going.
Yeah.
Maybe the most important question to you is one of our major students of monetary economics.
Yeah.
Have you ever seen fiscal discussion more in monetary economics than this is now?
I never thought I would. This is something that in my professional career dating back to the 70s as a college student, I never anticipated, and I don't believe I anticipated it 3 or 4 years ago.
And I think that needs to explain this, Rex. Monetary is like the Fed, it's like central bank, it's ISLM. Fiscal is a budget and is a Treasury Department function.
And involves the Congress and the White House. Yeah. Exactly.
Here's a chart here. Inflation, OECD inflation.
Got it.
Post-Volcker average CPI from about 1987 is 2.42%. G7 inflation is 1.7%. Professor, what are we worried about?
Well, what we're worried about is we've gone through an unprecedented period of quantitative easing, of printing money, and that was the appropriate policy given the severity of the recession and the financial shock. What we see in commodity prices, what we see in gold, what we see in inflation expectations, those are starting to drift up. The Fed is indicating, and other central banks, we can exit, we will exit, we won't let the genie get out of the bottle, but certainly, that is a potential concern that central banks will need to address.
Yellen says rising commodity prices don't warrant policy shift.
Yeah?
You just mentioned Richard Clarida, folks. Break exclusive. Richard Clarida out front of the vice chairman, just speaking up here, the chairwoman, just speaking up about how commodity prices are outside the study of Bernanke, Dudley, Yellen. You just said that they don't care, do they?
Well, no, it's not. I don't think it's that they don't care. It is the case that over the last 15 years, commodity prices have been mean reverting, which means periods of sharp rises in commodity prices are followed by sharp declines, and thus they basically add noise but don't change the trend of inflation.
Is Pimco investing that way, the emerging markets crew under El-Arian? Are they investing assuming it comes back at mean reverts back?
Well, I'm not going to get into that part of the investment strategy right now. What I will say is that there are secular forces at work in terms of rapid growth in the emerging world, in terms of supply constraints in many commodity markets that could lead many to believe that there is an upward trend in commodity prices that won't fully mean revert this time.
Let's take two things of the note quickly here. Nicholas Kies, this from Munich Credit over in Germany. Commodities will continue to trend higher, going opposite of what the vice chairman was talking about. Corn inventories are alarmingly low, and wheat plants in the U.S. are in much worse shape than in previous years. We cannot support the view of falling grain and agro prices. Some of the market economists really pushing against the history of academic economics.
Well, yes, and I think it's really, right now, it's just the history of commodity prices in the last 30 or 40 years, but the new factor that wasn't relevant in the 80s and the 90s is this rapid growth, the emerging middle class in China, Asia, India, in the global economy.
William, can we bring up the formula, please? I'm going to start crying here, folks. Gaussian, it's a little fuzzy there. Oh, this is absolutely, look at that. It's the high school bell curve.
Yeah.
Gaussian or normal. This is the perfect world that we work in financial and financial economics, isn't it?
Well, and especially in much of theoretical financial economics, I think the best applied work recognizes that actually doesn't describe the world, and you have to come up with alternative ways to think about it.
And the tails are out there to the side.
And they're very skinny, yeah.
Are we in better shape than we were? If we have Gaussian certitude, we're in better shape than 2 years ago.
Oh, certainly, absolutely. No, I wouldn't. I don't think anyone would trade places with where the economy was in 2008. So we're in a better place.
Two people in the control room just passed out seeing that chart.
There will be a quiz.
They were falling asleep. Thank you, Rex. Okay, we'll wake you up when we come back. Richard Clarida, thank you so much.